Good Monday morning. It is August 31st, last day of August. I can't believe it. This is the Naples Money Managers with our financial news you can use. Joining me today will be John Kincaid, sitting right there, and then Dennis Nelson will join us a little bit later. I forgot to say this last week, but I boycotted wearing red once the market dropped to its lows in March. And I hadn't worn red until last Monday. So now I'm comfortable wearing red again, which leads us to a whole nother conversation. I'm comfortable wearing red again because the market's now back up to where it was. So let's talk a little bit about your experience way back when you were just a wee boy. Well, say maybe a young man anyway.
Right, so it's interesting to look at our markets and ask yourself, am I willing to deploy my cash at this juncture in the market, because we're close to back to the all-time high on the Dow, all-time high on the NASDAQ and the Standard & Poor's 500. And so what I did is I thought to myself, if I had $1 million to invest today, what would be kind of the process to do that? And my thinking was, I wanted to go back and look at what the Dow was 30 years ago when I started as a financial advisor at Merrill Lynch. So these are some of the things that I found, and the results that I found, basically for me, show a trend. So my question...
Wait, a good trend or a bad trend?
I think a fascinating trend.
Fascinating trend. Good answer, right?
And the reason I say trend is because if you're going to allocate money to an advisor, whoever that may be, a portfolio manager, they need to be aware of these trends, and that needs to be part of their strategy. And if it's not part of the strategy, you're simply getting possibly a plain vanilla approach to the market. But I looked at the Dow 30 years ago, and what I found was no longer is General Electric in the Dow. General Motors is not in the Dow. International Paper, DuPont, Bethlehem Steel, Allied Signal, the Aluminum Company of America, and a famous one, American Can, which used to be talked about quite a bit in the Dow when I first started 30 years ago. The interesting thing in this trend is this. Of the 18 companies that are not in the Dow today,
right,
that were 30 years ago, they have been replaced by companies like Cisco Systems, Home Depot, IBM, Intel, Microsoft, Visa, Walgreens, and Walt Disney. And the reason I mention that is because the first 8 companies out of this 18 new companies in the Dow, the first 8 companies are solid technology producers in some way, shape, or form. Apple, Salesforce that does software. The next 6 that make up the 18 are companies like Walmart that have totally embraced the internet to be able to sell their products. The last 3 are large pharmaceutical companies who have in the last 5 to 10 years merged and acquired biotechnology companies. It may not be electronic technology, but it's definitely new technology. The trend for me is this. The portfolio manager that you hire for your money should understand these trends, and you should see some of these companies in your portfolio.
That makes a lot of sense, because I've heard so many people say, especially if their husband has passed away, my husband said never sell these stocks.
Right.
These are great companies, never sell them. And for a long time that was probably true. But your investment managers have to be willing to make change, to look at the trends, to change with the times, to slowly move portfolios, turn that ship around so that it's facing the right direction. And that's what private management, active management is.
Good point.
And I think that's what we do. So that's
Absolutely.
a great lesson. There was a guy, Mr. Cooperman, I think, on this morning on CNBC, and he was talking about the Nifty 50. And he started listing stocks like Eastman Kodak and all these other stocks and their huge price earnings. That means how much they earn according as it compared to the price of the stock. They were huge. They were nowhere near the level of the stock. And most of them were gone. They were gone. It was just, I guess I hadn't thought about it. I've been in the business 35 years, and these companies just disappear. But we're not going anywhere. So John, we're gonna have Dennis Nelson come over now. And while we're waiting for Dennis to join us, remember the 5 types of investors I said we had? And right now with the market being at this level, and what we're trying to do is make it so that you feel very comfortable with where you are. There's the type of investor that says, you know, I've got Amazon, Apple, and Facebook, why do I need to own anything else? And then there's the other investor that says, and we can go over all these different, why own anything at all? The market's at an all-time high, why should I do that? Then there's, why do I actually own this? We've had that a few times with a no name. And Dennis may talk about a few of our stocks in our portfolio that, and why we have them. You may not have heard of them. Oh, I wish I would have owned that investor. That's the one who always looks backwards. And I have no idea what I own or why is the last type. And all they look at is the bottom line, and maybe that's okay too. But there's just 5 types of us out there. So we have to figure out where we fit and then how do we deal with the questions that we have. Dennis, what do you got?
Well, that's a lot.
Come on, process here.
You know, we tend to look at things with the 30,000 foot view. Where are things going? What are the directions? What is the power of the universe? Excuse me, of the internet, for instance. And of course, that's what this has all been about. You look at Facebook. Wow, what a job they have done dominating a market, dominating demand, and just bringing about huge changes. Microsoft, another good example. Amazon, of course, we could talk about Amazon forever, but all these stocks are at all-time highs. Do you buy Amazon at $3,500 a share? And even more, do you buy Tesla, which just split, by the way, 5 for 1, is still at $450 a share, or thereabouts. How much can you spend, and how much can you invest in a future that hasn't quite arrived yet? I think that's a pertinent question.
Well, Tesla's price you just gave us before the split. Right?
No, after the split.
It's $450 a share after the split? Well, it shows you where I'm looking.
Yes.
I apparently don't have any Tesla.
It's you know, people are looking at an age when all cars will be electric, and no doubt if that ever happens, and I suspect it will, Tesla will be in a great spot. $450 a share, I don't know. But the other question, the shorter term view. You know, we're getting people saying, is this a good time to be in cash now with the elections coming up? Stocks at all-time highs. My answer to that is really no. When I got into the stock market originally, as a young broker back in 1974, the Dow was at 550. Now there's been a lot of ups, a lot of downs since then, but I can tell you that you got to be long, you got to be in the market. If you suspect the market is high, you need to be in stocks that aren't high, that are defensive. You look at stocks like Home Depot that has gone up, that is following a trend that has really succeeded since the coronavirus, when people are starting to fix up their houses. I suspect that trend is going to continue. And yet here it is, a good solid company. They've been around, they pay a 2% dividend in a 0% world. That ain't too bad. And we can go on. Those are the type of companies we want to focus on. Solid companies that haven't tripled or quadrupled here over the last few years, but that have a good business model and that pay a dividend. Almost all the stocks we own pay a dividend. So does that help?
No, it does help because we have our double dividend strategy, which everybody knows reduces the risk of being in the stock market by 50%. If you're one of our clients, you know, especially those of you who have been with us for almost 30 years, we have been through ups and downs like this continually, and it's always the same stress. It's always the same question. Do I get in? Do I get out? When do I get in? The key is if you're coming new into the market, we take you in slowly. Or for some of our clients, depending on their vulnerability and they need growth, we'll use a guaranteed Jackson. I'm going to use the word Jackson because when I use the word annuity, it gets all screwed up. the Jackson annuity to protect the growth with a guarantee while we slowly move in on our covered call side into the markets with that double dividend strategy to protect you. The worst thing you could do is say sell in May and go away. Well, if you had done that this year, you would have missed the last, 15%.
Yep, and I can tell you from experience, when people get out thinking the market's gonna go down, they may well be
It usually
right.
does.
They may well be right. They rarely get back in
So that's the key.
at an advantageous spot. Because when you really need to be buying, the market's all so low you're scared to death to buy.
So feel free to call us at any time. We're here to talk. Marcus, John, Dennis, myself, or me, we're here to talk. And when you look at your video when you get it, if you just put your cursor down a little tiny bit on the video itself, you can see a CC, so you can hit that for closed caption. We're trying to get that on there permanently. It helps if you have low sound issues. Also, if you scroll down just a little bit more, you'll see a button that says subscribe and one that says share. Please subscribe and share. Let's get our word out there that the world is not coming to an end. This is the Naples Money Managers. And remember, money matters, but most of all, most importantly, you matter. See you next week.